Welcome to this video series about measuring value creation in private equity, where we look at things like how natural logarithms can explain private equity returns. My name is Mike Reinert. I've worked in the industry for 15 years. I run a website called AUXILIA Mathematica, and I wrote a book titled Private Equity Value Creation Analysis. These videos cover findings from my work, website, and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download all the Excel files behind every episode. This is video number 5 in the value creation series. Last time we demonstrated the derivative model of value creation, and here we will describe the logarithmic model of value creation. Compared to the conventional model described in VC102, these models do a better job accounting for the influence of leverage and growth capital. While the Munich model in VC103 does a decent job with the leverage calculation, these two models do it better, and they work with data that you're more likely to find in fund reporting and GP marketing materials. Let's take a look. As with the derivative model, we start with the gross return as the fundamental unit of value creation, and derive all the other value drivers from there. In the logarithmic model, the fundamental unit of value creation is the gross multiple of invested capital, total realized and unrealized equity divided by invested equity, or FEC-V2 divided by FEC-V1. This is the same as a deal's gross multiple that you'll find in a deck or a quarterly report. And then, just like in the last video, we will define a number of relationships that allow us to express FEC-V in terms of various capital structure, P&L, and market metrics. Please go back to the last video if you want to see how these terms are defined and derived. Again, like last time, FEC-V is a function of time, and so are the variables in this equation here because TTM EBITDA, the valuation multiple, the equity ratio, and the fund ownership percentage, they also change over the holding period. Therefore, at entry or T1, FEC-V1 is equal to the product of E1, M1, ER1, and Phi1. Further, at exit or T2, FEC-V2 is equal to the product of E2, M2, ER2, and Phi2. Now, the gross multiple of invested capital is equal to FEC-V2 over FEC-V1. So it must also be true that it's equal to the product of E2, M2, ER2, and Phi2 divided by the product of E1, M1, ER1, and Phi1. The commutative property of multiplication says that we can rearrange these variables as follows so that the gross multiple is equal to the product of E2 over E1, M2 over M1, ER2 over ER1, and Phi2 over Phi1. And believe it or not, we're basically done. These ratios, like E2 over E1 and M2 over M1, they are the logarithmic model units of value creation. They are just as valid as the absolute value creation units that we saw in VC104 or the times money value creation units that we saw in VC103. I call them equity return multipliers and designate them with the Greek letter chi. Here's how they work. If EBITDA increases, E2 will be bigger than E1, and that makes the EBITDA growth multiplier greater than 1. This has a positive influence on value creation that works to increase the gross multiple of invested capital. If the GP's ownership percentage decreases due to dilution, then Phi2 will be smaller than Phi1, and that makes the fund ownership multiplier less than 1. This has a negative influence on value creation that works to decrease the gross multiple of invested capital. So equity return multipliers that are greater than 1, they increase value creation, and equity return multipliers that are less than 1, they decrease value creation. Now we know that the product of E and M is the total enterprise valuation, so we can rewrite the formula as follows, and this gives us the equity return multipliers for the unlevered return, the leverage effect, and fund ownership impact. Again, the product of TEV and the equity ratio is total shareholder equity, and this gives us the equity return multipliers for the isomeric return and the fund ownership impact. And finally, the product of TEC-V and the fund ownership percentage is the GP or fund level equity value, and this gives us the fund level equity return, which is simply the gross multiple of invested capital that you find in the quarterly report. Now, in the derivative model, we saw that the value drivers were related to one another by addition and subtraction, but here they're related by multiplication and division. So the product of the equity return multipliers for EBITDA growth and multiple expansion is the unlevered return. The product of the equity return multipliers for the unlevered return and the leverage effect is the isomeric return, and the product of the equity return multipliers for the isomeric return and fund ownership impact is simply the gross multiple of invested capital. Now you may be wondering why I call this the logarithmic model of value creation. At this point, there are no logarithms, natural or otherwise, in the formulas, But you will see them in the next video when we convert these equity return multipliers into the other measurements of value creation. In the derivative model, we looked at the instantaneous change in fund equity value and used some basic calculus to measure how absolute change is driven by absolute changes in EBITDA, valuation, equity ratio, and fund ownership percentage. In the logarithmic model, we're looking at the continuous change, which is the natural logarithm of FEC V2 over FEC V1. This looks a little funny, but it's not too far from the traditional percent change measurement, and it has very useful characteristics. Logarithms are a big deal in mathematics because they convert multiplication problems into much easier addition and subtraction problems, and this was essential back before calculators became ubiquitous. For example, we know that the gross multiple can be expressed as follows. The natural logarithm of a product A times B is equal to the natural logarithm of A plus the natural logarithm of B, so we could split up the equity return multipliers as follows. This means that we can express continuous change in the gross multiple as equal to the sum of continuous changes in EBITDA, valuation multiple, equity ratio, and fund ownership percentage. Okay, so let's see these equity return multipliers in action. We'll go back to the same company we discussed in the last video, where enterprise valuation grows from 100 to 180. It pays down debt from 20 to 0, its total shareholder equity grows from 80 to 180. During that time, the GP's equity grows from 44 to 88, and the company's EBITDA grows from 20 to 30 over the hold. These numbers give us the T1 and T2 equity ratio, phi, and valuation multiples that you see in the table. Value creation in the logarithmic model is the GP's gross multiple of invested capital at 2x. Total shareholder value creation is the isomeric return of 2.25x. Here we see that the GP underperformed the shareholder group as a whole. It's dilution that makes the GP's return a little worse than the other shareholders and is driven by the fund ownership multiplier being less than 1.0x. The product of these numbers, 2.25x and 0.89x, give us the gross multiple of 2.00x. The enterprise valuation figures give us the unlevered return of 1.8x, and the equity ratios give us the leverage effect of 1.25x, and the product of these two numbers provide the isomeric return of 2.25x. Again, a 50% increase in TTM EBITDA provides EBITDA growth of 1.5x, and a 20% expansion of the valuation multiple provides multiple expansion of 1.2x, and a product of these two numbers provides the unlevered return. And of course, if you multiply together the equity return multipliers for EBITDA growth, multiple expansion, leverage effect, and fund ownership impact, you will get the deal's gross multiple of 2.00x. One of the nice things about the logarithmic model is that it's really easy to calculate the value drivers right over here on the table where you organize your data. Here's what the model looks like in a chart format, and you can download the Excel model for this one on the website. The key thing to remember is that any values that are greater than 1x will always drive the deal's multiple higher, and any values that are less than 1x will always drive the deal's multiple of invested capital lower. So these are the fundamentals of the logarithmic model of value creation. Compared to the derivative model we saw in the last video, the value driver equations are a lot simpler because each of them only require two numbers. However, the concept of equity return multipliers is a bit less intuitive. It's harder to wrap your head around it. The derivative model calculates absolute value creation in dollars, which makes a little bit more sense and provides us those familiar value bridge charts. Now, it turns out that the derivative model's absolute value creation measurements can be converted into equity return multipliers, and the logarithmic model's multipliers can be converted into absolute value creation measurements. And that's what we'll focus on in the next video. What we'll find is pretty amazing. The derivative model formulas and the logarithmic model formula equations are going to look quite different, because they have different starting points. However, once you run the numbers and convert the results to a common measure of value creation, you'll see that the results of the models are usually within a few tenths of a percent. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.